Turo is the world's largest car sharing marketplace, and it's the perfect app for travel.
I was recently traveling overseas for 7 weeks in multiple cities. Turo made it so easy to find the type of car that I needed in each city, including various things like a car seat, snow tires, and a lot of space.
I live in SF, Austin, and Sydney, and I use their cars wherever I am and when I'm traveling. I don't have a car in SF and Austin, and we just use Turo. The booking process is so convenient, and the hosts are awesome. Go to Turo.com and download the app today. Sendar is the OG startup accounting firm in Australia, catering for all stages of your business's life.
If you're busy running your startup, you don't have time to do your own books and forecast. Instead, fully outsource your finance function, giving you time and resources back to focus on what you do best, which is growing your business.
For a free 1-hour consultation about your business's growth plans and finance needs, head to sendar.com. That's SCENDAR.com.
Are you building a SaaS business and looking to achieve compliance with SOC 2 and ISO 27001 or other security and privacy frameworks?
Compliance can unlock major growth and build essential customer trust, but let's face it, it's usually time-consuming and expensive.
And really kind of a pain. That's where Vanta comes in. Vanta automates up to 90% of customer compliance tasks, making you audit ready fast and saving you up to 85% of the associated costs. Plus, Vanta scales with your business, offering a market-leading trust management platform to continuously monitor compliance, unify risk management, and streamline security reviews. Join 7,000 global companies, including Atlassian and Dovetail, that trust Vanta to build and prove their security in real time.
And for our listeners, Vanta is offering 10% off.
Just go to vanta.com/first. That's VANTA.com/first.
Okay, 3, 2, 1. Hey, I'm Cheryl.
I'm Maxine.
This is First Check, part of Day One, the network dedicated to founders, operators, and investors.
If you want to be a better early stage investor, this is the show for you.
So TLDR, if you don't want to suck at investing, listen up. Today, we are going to be talking about fund of funds, which if you don't know what that is, don't worry. We're going to get into that as well. I'm not even 100% sure, so I'm probably going to be learning a lot from Maxine in this episode.
It's a new format for us to experiment with. We're going to try doing some primers. We got some feedback from you all that's really helpful as we do kind of deep dives on particular topics. We got a lot of great feedback about the kind of intro to angel investing. And so please keep that feedback coming. You know, if there are topics you want us to do an unpack of, do a primer on, let us know. We have a couple of ideas in mind, but this is our first experimentation. We suggest consuming this in parallel with our session with Trang from Transpose Partners, because she gives you a great example of how she applies it, but excited to dive in and talk about funds of funds.
Yeah.
So Cheryl, should we start with what is a fund of funds?
So help me understand here. A fund of funds is basically where somebody creates a fund. Like if I go out and I'm like, hey guys, or hey LPs, I'm raising a fund. But instead of investing in companies, I'm going to go invest in funds. And to be clear, not the company that's running the fund, not the management company, but actually the fund. I'm going to give that fund money. And I'm going to do that with a bunch of them. How many would a fund of fund typically invest in? Is that right?
Yeah, no, that's right. That's right. So I think they invest anywhere between kind of 10 funds, and the biggest one I know of per fund has invested in 100 different funds.
Whoa.
So big, multi-stage. I think, so the first thing, maybe a couple of reminders here just to make sure we're kind of anchoring in what this ecosystem looks like. So first reminder is the structure of a venture fund. So the structure of a venture fund is, think of it like separate buckets. You have a bucket, which in the US is called the GP Co, or the General Partnership Company. In Australia, we have different legal structures, but we kind of use the same terminology. So we have a bucket or a company that is the GP Co. That is like Co-Ventures Pty Limited. It is the entity that runs the venture fund, so the actual company. And then there is a separate entity, a separate bucket that is your actual investing fund. In Australia, we use a kind of range of different vehicles. In the US, they use limited partnerships, which is why we have that kind of terminology of LP, but you have kind of different entities which represent each individual fund. So let's say in Co-Ventures Fund 1, that is a standalone bucket, and that bucket will invest in 30 different individual companies. Actually, in our case, 33 individual companies. And for that investment, we will receive shares into that bucket, so into CoVentures Fund 1, and our investors will invest into that bucket. So you can imagine, a large-scaled fund like Blackbird or Sequoia, they have multiple of these buckets, so multiple funds, and each of these funds has its own set of investors that invest into that bucket and companies that bucket invests into. Now, it gets more complex because over time, investors in Fund 1 might invest in Fund 2 and Fund 3. So you might have the same investors into each of these buckets. But as a structure, it's actually separate from the entity that does the running of the venture capital firm and the entity that does the investing into the companies are two separate things. So a fund of funds is this structure, but instead of investing into the company, it invests into these buckets like CoVentures Fund 1 and is an investor into that bucket. Now, there's complexity into the ways that they invest, but generally speaking, that's what a fund of funds is. So they construct a portfolio of these funds, anywhere between kind of 10 and 10 and 100 of them. And they run the strategy very similar to a venture fund runs their strategy into the directs. The kind of second reminder is that the startup ecosystem and returns in the startup ecosystem over the last 30 years have consistently been shown to be driven by outliers. So this is the thing that you will hear a lot of investors talk about and a lot of managers talk about, which is this idea of a power law. The power law is a statistical terminology. It refers to the fact that where there is a distribution of returns in the underlying startups and or the fund managers, the majority of your returns are driven by, anywhere as little as 10% of the actual investments you make. Venture funds being an indexation of the underlying assets. So a venture fund invests in our case, 33 companies. Our success is driven by, an outlier in our portfolio. Similarly, the venture funds themselves, their returns perform on a power law curve. So there's only a handful of venture funds, that will deliver outlier returns to their investors. Actually, the majority of venture funds return less than 1x capital. So they just straight lose money.
Isn't that interesting? Because I can't remember who we were talking to, but one of our other guests said that the jump from Fund 2 to Fund 3, I think, was one of the hardest. Mm-hmm. And that you can kind of raise Fund 2 on the paper value of Fund 1. But by the time you get to Fund 3, they're kind of looking back at Fund 1 and going, okay, well, what did that actually happen? It kind of seems like that's part of the reason, right? If most funds actually fail, you're going to know that fund is failing by the time you get to start to raise to Fund 3, which is really interesting. So it would be basically me starting a fund and saying, okay, you guys invest and I'm going to go invest in Blackbird, SquarePeg, Airtree, CoVentures, Black Nova, Archangel, and every other VC fund that I can name in Australia or globally, right. Basically. But why, as an LP, why would you want to do that? Why, if I can invest in a fund that's going to invest in those funds, surely I have enough to just go and invest in those funds.
Yeah, I think there's a really interesting reality here in the kinds of investor that invests in a fund of funds. So I think especially for kind of angel investors or operators, it's kind of a whole world that is fairly opaque and hard to see into. But very interestingly, for example, in Australia, the super funds, they are deploying so much money, right? They have so many assets under management that to invest $200,000 of their billions of dollars in assets under management into a fund that is raising, say, 10 million just isn't worth it. The amount of time, the opportunity cost for them to source that opportunity, write that check, and then manage that asset is just not worth it. And they don't want to write a, say, $2 million check into a $5 million fund because then they are too overweight for that manager.
Yeah.
So that manager then they're too overweight with that one LP. And so they actually create risk in the underlying LP. A thread that I want to pull there, you kind of mentioned the failure to graduate from Fund 2 to Fund 3 is driven by the potential underperformance of Fund 1. I think what's interesting at least as I understand it, the failure to graduate from fund 2 to fund 3 sometimes is driven by the complete failure to deliver returns, but more frequently is the failure to sophisticate your fund, like the venture firm, the actual business, the management company.
The management company. Yeah. That's what Trang was talking about.
Yeah.
That like, she looks for firms that are actually developed and have a platform for the startups that they're supporting.
Right. So I want to kind of unpack that a little bit because I think it's relevant for fund of funds. Because similar to venture funds, where you have venture funds that have like an early stage mandate and venture funds that have like a growth stage mandate, you also have funds of funds that have emerging manager mandates, meaning the manager is on fund 1, 2, or 3, or they have established manager mandates. So I'll come back to that in a moment. But the kind of failure for funds to graduate from fund 1 to fund 2, fund 2 to fund 3 is actually very similar, or as the way that I understand it, is very similar to the failure for startups to make it to scale.
From like seed to Series A?
Yep. Yeah. So
interesting.
Yeah, it's fascinating, isn't it? How the way that it kind of like mirrors down to the stages. So the failure to graduate from fund 1 to fund 2 and fund 2 to fund 3 is, you fail to make money. You invest in a bunch of companies that don't make money. You fail to keep your partnership alive. So partner breakup in early stage fund managers is a very common reason that they're not, the companies are not successful. Sorry, that the funds are not successful. To kind of anchor here, though, interestingly, at the fund manager level, the timeline for success is way longer. So fund 1, fund 2, and fund 3, you are treated as an emerging manager, which is a nice way to say like you're essentially a rookie. We don't know whether you're any good at this or not.
Like pre-revenue?
Yeah. Yeah. So like we will treat you as a novice for this. And fund 1, well, like general fund deployment periods during 2021 and like 2020 and 2021, they got down as low as 2 years, but they're mainly like 3 or 4 years. So we're talking about a period of time you're treated as a novice that's anywhere from like 9 years to 12 years.
Could you imagine doing something for 12 years and being like, hey guys, I'm a novice?
Yeah. I mean, like, yes, I can imagine it because it's what I've just signed up for. It's like,
right.
It's kind of a wild experience.
But imagine if you were like skiing and you're like, yeah, I've been skiing for 9 years, still a novice.
Yeah. Still a novice, like a complete rookie. So there's also the kind of element where funds of funds that invest in kind of experienced managers or not emerging managers, they have anywhere between 9 and 12 years worth of fund track record and usually, a number of years of angel investing track record. And so over that period, given the nature of this underlying asset class, you should be able to show that you, number one, can invest in interesting companies, you can find them, you can win them, and you can invest in them. You should start to see some distributed capital back out to investors. So you should start to see some what they call DPI, the amount of money distributed versus the amount that was paid in, distributed to paid in. So you should start to see that DPI back to investors so that they can look at that. Essentially, like at the underlying company level, it's that validation that, hey, you actually built a company that made money. And then also they fail to make that graduation from fund 3 to institutional level because the company that they've built, the kind of management code that they built isn't ready for scale. And so you can imagine if you're a big super fund or a big pension fund, you need a level of sophistication with your fund manager that is above and beyond just the ability to find and invest in interesting companies. You need certain security requirements. You need, in these days, certain ESG requirements. You need a certain level of finesse and sophistication on your actual investment process. You need to be able to report to them in a really scalable way a whole bunch of information about your portfolio companies. You need to also be able to show that track record. So you're like, as an investor, de-risked, reminding that these fund managers, these big pension funds, like they need to report to their investment committees to be able to say like, this is a, quality, a highly capable investment fund manager.
But you talk about this in the sense that like you're saying, it kind of sounds like you're saying that only big institutionals or supers are investing in funds of funds. Like surely other people like, the way that Trang was talking about it, like she talks about it, that there are individual LPs. Surely there are family offices and even individuals like me. Like, would there be any value in, what if I wanted to invest in a fund of funds? Let's say, I had an extra $1 million lying around and wanted to throw it into a fund of funds. Is that like, am I just not the target market? Are individuals not the target market for this?
Oh, absolutely. Yeah. I mean, I think they usually have you can imagine, because a fund of fund is investing in a larger number of funds than if you were investing directly. They're fairly big funds, right? They're like,
yeah,
20, I've seen kind of 50 mil plus.
Because like, couldn't my $1 million go a much further way, right? If I went to 4 funds, give them 250,000, or I went to a fund of fund and give them $1 million and they put that into 50 funds, or even more than 4 at least.
Yeah.
Would that get me a better outcome though? Like,
well, I think it depends, right? So like, to answer the first question, absolutely. As an individual, there's nothing that stops you from investing in a fund of funds other than the buy-in being like the minimum check size being very large. The value proposition for investing in a fund of funds is a couple of things. One is there's the kind of folks of like, they sell access. So they have allocations in funds like Blackbird or Sequoia or Airtree or any of those like big, very established, successful funds. Those fund managers don't want to have to deal with the long tail of investors. They want to herd cats of a bunch of individuals in. And so it can be more valuable for them to work with a fund of funds than, into like individually direct investing. And so sometimes, right, if today, even if I had $20 million, I can't call Roelof Botha and be like, hi, I'd like to get into your next fund. He'd be like, sorry, we're fully allocated.
Right. So it's getting access to funds. Yeah. Okay.
Yeah. And so that is like one model, right? The fund of funds sell access. The second is diversification. So I think I mentioned there's some funds of funds that invest in funds 1, fund 2, and maybe even fund 3. So they are emerging manager funds. By investing in a fund of funds, you allow yourself to diversify across emerging managers as opposed to being exposed to a single underlying asset in the same way that you invest in a fund to diversify across startups.
So you're mitigating that risk for the funds that aren't going to survive.
Correct. Yeah. And so, emerging managers consistently are in the top 10 performing funds of every single vintage. For the last, 15 years, they've been anywhere between 40 to 80% of the top performing funds of every single vintage. Emerging managers are more capable of finding kind of underexploited opportunities in the ecosystem because they're generally investing out of smaller funds. They're also generally kind of closer to the opportunity set than they were previously. Than a big, like large fund like a Sequoia. And so interestingly, they can continue to deliver higher percentage returns. But the challenge is that let's remind ourselves of the drop-off rate, their success.
Yeah, I was going to say, like, that's such a conflicting view between, like, most of these funds don't survive, but also they're more likely to find the winners. Like, that makes no sense to me in my brain.
Right. I think it goes back to, the ability to survive and build the business around the fund that you're driving. Let's remind ourselves of the structure of the venture capital fund, right? You have a management co. And so as a fund manager, your job is to build that business. So that is the kind of Co-Ventures Pty Limited in Australia. And then you have the actual fund that you build, Co-Ventures Fund 1. And so that Co-Ventures Fund 1, you might find 3 or 4 amazing companies in that group. But your ability to sophisticate the management co to the point that institutionals will invest in it might not be there. Or you might, like, let's say you have a 3-year period where because you have one particular insight in the ecosystem or there's a particular moment for alpha, you might deliver this incredible fund 1, but fund 2 sucks. Or you just don't get lucky, right?
Or you make such a good investment that your carry is like $1 billion and then you're like, well, why do I even bother?
Right. Yeah. I think all of those things are possible. And so there's many reasons that a fund manager doesn't graduate fund 1 to fund 2, fund 2 to fund 3, fund 3 to fund 4 an institutional grade that are not correlated to the success of the funds that they actually run.
Do we have any funds of funds in Australia? Do you know any?
I don't think so. So I think I can't think of any off the top of my head. You have a bunch of family offices that run.
Yeah, they invest in multiple funds.
Yeah.
Yeah.
And then you have a bunch of like multi-family offices that invest, like maybe pool capital together and then invest in a bunch of funds. But I wouldn't think of that as a fund of, like a traditional fund of funds.
No. Usually they're doing that through like a wealth manager rather than like a fund manager, right?
Yeah. Usually there are some examples of a multifamily office. So they've got like one entity that a couple of families will invest into.
Yeah.
And then that entity invests into funds as well as directs. But I wouldn't think of that as a more traditional fund of funds.
No.
A more traditional fund of funds would be like Trang, right? She like builds a vehicle. She gets a whole bunch of investments into that vehicle.
Yeah.
And then that vehicle goes and invests behind a particular thesis with a particular like support mechanism for a particular kind of asset, and she manages that asset and then she distributes capital back to her investors.
Yeah, which in her case is finding exceptional fund managers, backing them, supporting them, and then getting the returns from those.
Yeah, on Fund 1 and Fund 2.
Yeah.
So she is an example, Transpose Partners is an example of a fund of fund that has a emerging manager thesis, whereas like Harborvest, which is a huge asset manager, multi-stage asset manager, they have an emerging manager strategy, but they also have fund of funds that sell access. So they are in like Excel, Sequoia, etc.
There seems like there'd be an opportunity in Australia to build something that would invest in at least some of the more emerging funds.
100%.
Right? If we have this thesis that, or we have data that backs that they are more likely to find some of the bigger outliers in the next generation, right? And if we're going into this new period of possibly looking like the kind of 08 to 2012 period where some of the greatest wealth creation in history was created, and we're going into another period of that, looking at some of these early funds that are coming up now, like co-ventures, and assuming that they are probably going to find the next canvas of the world, maybe we should convince someone to start a fund of funds.
Yeah, there's a couple of people playing around with it in Australia in various versions of it. Like a venture firm, there are like multiple ways you can chase this strategy. And so like multiple different ways that you deliver the business of getting access to emerging fund managers.
Are you building a SaaS business and looking to achieve compliance with SOC 2 and ISO 27001 or other security and privacy frameworks?
Compliance can unlock major growth and build essential customer trust, but let's face it, it's usually time-consuming and expensive.
And like really kind of a pain. That's where Vanta comes in. Vanta automates up to 90% of customer compliance tasks, making you audit ready fast and saving you up to 85% of the associated costs. Plus, Vanta scales with your business, offering a market-leading trust management platform to continuously monitor compliance, unify risk management, and streamline security reviews. Join 7,000 global companies, including Atlassian and Dovetail, that trust Vanta to build and prove their security in real time.
And for our listeners, Vanta is offering 10% off.
Just go to vanta.com/first. That's VANTA.com/first.
I do think, so something to name with a fund-to-fund model. So a reminder, venture capital firms generally operate on a 2 and 20 model.
Yeah, I was going to ask about the fees. Like how...
Yeah.
Are there fees on fees here or?
Yeah, there are fees on fees. And so the challenge, I think, in the Australian market is, and across markets, but for this strategy is... You have the underlying fees from the venture fund, which is 2% of committed capital per year in management fees. So for the fund manager to actually run the venture capital like business, and then you have a 20% carry. So that means of the profit that a venture, like the actual fund makes, the fund manager, so the Co-Ventures Pty Limited, gets to take 20% of that success rate, with some more complex math underneath that, but generally that's how it operates.
Yeah.
So that's commonly known as the 2 and 20 model. So you can imagine as a fund of funds, you have the same needs, right? Like you need revenue to be able to run the company that does all the sourcing, that does all the evaluation and all of the support. So there has to be some fees on the capital that is allocated. And also you take carry. Now, they generally, because it is a less actively managed asset, they generally take less fees and less carry. So I've seen anywhere between kind of a 0 and 30 model through to a kind of 1 and 10 model.
0 being
no management fees.
No management fees, but only 30% carry?
30% carry.
Okay.
Yeah. So you can imagine 30% carry stacked on 20% carry starts to be extremely expensive on the success.
Yeah.
So the way that that makes sense from a returns profile perspective is those investors into the fund of funds are thinking about, okay, what's my return profile net of fees? So you're thinking about de-risking here versus how much, return you're getting for it. So maybe it's for those folks that are running a kind of wider strategy. For some in the US, it's very common for the like big pension funds to run an emerging manager strategy as essentially a sourcing vehicle for them. So it comes out of a different allocation pool than it comes then from the kind of direct investments. But it is, it's still an expensive model to run. So as a manager of a fund of funds strategy, you need to be very thoughtful about the way that you structure your fees and stack your fees so that it's still net of fees, meaning the return that an investor gets after the fund manager has taken all of their fees, it's still an attractive option for those fund allocators.
And you really need to think about it in terms of like, are you really going to get that? Like theoretically, if you're more diversified, right? Like you invest in a fund so that you can get more companies. You invest in a fund of funds, you can get exponentially more companies. And, Trang has thousands. But like, do we have to buy in? You would need to buy into the thesis that more diversification equals better returns, right?
Well, risk-adjusted returns. The nuance there is risk-adjusted returns. So more diversification means technically you're taking less risk because you're not exposed to a single fund or a single startup. You are exposed to anywhere between 10 and 50 of them. And so you are more likely to find that fund that returns, like Blackbird Fund 1 is like on a 45x or something. Like it increases the probability you find something like that.
Yeah. But like, can you really do the math on that to say, I believe that because I'm 10x more diversified, that I will have a 10x better return, and that justifies, it's not 50%, right? So it would be 20% carry on and then 30% on that. So like it would equal out to, I can't do the math on that, but
I think the math you're doing here isn't like I'm investing in 10x more companies and therefore I need 10x the return profile. The math you're doing is the probability. So for example, if I chose to invest directly myself into a bunch of companies versus invest in a single fund manager versus invest in a fund of funds strategy, at each of those layers, what's the probability that I find the outliers? Because ultimately, that's what we're trying to do here, right? Like we're trying to find the outlier return. We're trying to find those like 10 to 100x.
1000x returns, the canvas, right?
The canvas, yeah. So because we're investing on a power law, I think it's important to remember that we are like thinking about both the long tail and how long that long tail and how negative that long tail is and how that counterbalances the success. So in the underlying companies, you have a bunch of zeros, whereas at the fund level, you probably don't have a bunch of zeros. You might have a collection of 1x's. Maybe you have a zero, but you have a collection of 1x's.
Yeah, like most of your funds return at least one.
Yeah.
Yeah.
Correct. And so the fund construction is different from a fund of funds perspective than it is for a portfolio construction perspective. So as an investor into a fund.
So it is less risky.
It's less risky. Yes, it's 100% less risky.
Yeah.
But it also runs the risk of, in the same analysis you would do with the underlying portfolio, you also run the risk of it being less value creating for you, right?
Yeah.
You might not find that outlier. But because you're taking less risk, you shouldn't expect a higher return, right? Return is a function of the risk that you are taking to be compensated for that risk. So because you're taking less risk, you should expect to have less return.
Yeah. I mean, well, that's why we invest, right? Like I could go and invest in an ETF, or I could go and invest in individual stocks or bonds, but I choose this. And this is just a slightly less risky version of the same type of venture investing, right? Like we're just sliding up the scale, still same asset class, but actually sliding up the risk scale, which I think is actually an interesting approach. If you were more risk averse, but wanting to still invest in this asset class, doing a fund of funds model means that you probably you have less chance of making like, the 1000x return that I'm going for when I invest in an individual company. But you have a higher percentage, you have a higher chance of, not losing all of your money like I do when I invest in an individual company. So I could see that being a driver of wanting to invest in fund of funds.
Yeah. It is also a reflection. So for a lot of the people that invest in fund of funds, they are large institutional asset managers.
Yeah. But individuals must do as well, right?
They do, but it's a smaller percentage of it, right?
Yeah.
Like you can imagine if you're raising like a $50 to $100 million fund, for a lot of them, minimum check size is $1 million. And there's only a handful of people in the world that have, portfolios of $50 million of investable assets. And, 10% of that is going into...
You can put 10% of that into alternative assets.
Yeah, alternative assets, right? So like we're talking about a asset class here that is only available to the ultra wealthy, which is why there's not a lot of information about it.
Well, that's why we're having this conversation, right? So we can share more. I think what's interesting for our group of investors out there who are emerging managers or early angel investors or even just angel curious is just how that relationship between like funds and other funds work and what that means for the downstream effects on the types of companies that you invest in, right? Like knowing that if you invest alongside, say co-ventures and co-ventures has a fund of fund that's invested in them, what does that mean for the potential success of the company later on down the road? Does it mean more money for them? Does it mean more support? Does it mean less support? Like, does it mean anything?
Yeah, that's I think a really interesting question. I think there's probably a nuance I would add here in that the Australian fund of fund ecosystems is largely like a fund of funds business that is coming out of a bigger asset manager. So like a super fund or a like big bank. They are investing in the venture capital ecosystem for those VCs to invest directly. And that differs from who is investing in the US or who are the big kind of anchor LPs in the US. The big anchor LPs are endowment funds. So the kind of Yale and Harvard endowments are the ones that...
And the Ontario Teachers Pension Plan.
Yeah. Like CalPERS, the Californian pension for, I think they're medical professionals or something like that. Anyway, they've got these big... But those, Ontario and CalPERS and those folks are slightly different, right? They operate very similarly to a super fund because they are pension funds.
Right.
So
okay,
the nuance here is as a pension fund.
Wait, what's endowment fund then?
An endowment fund is the universities. So universities in the US are big asset managers because they get an enormous amount of endowments, so gifts from their former students to the university to be able to fund the university's continued operations. And they're investing like billions and billions and billions of dollars of assets to then have a return on those assets, and they use the return on those assets to fund university activities. So the distinction here is that as a pension fund, you've constantly got people buying units, right? Like every single month in Australia, you have payroll run, and every single payroll that is run, 11% of that goes into a super fund. And that 11% of monthly payroll in Australia, you are purchasing units in your super. So you are buying the then present value of the assets that a super fund can deliver to you.
That is so interesting. Do you think, I certainly never really thought about the fact that actually each month, technically, I am investing in a fund.
Yeah.
That is managed by a fund manager.
Yeah.
And growing my own wealth that way. Like, I just don't think about it. You think, oh yeah, I'm saving for retirement. But
right.
No, it's actually every single month I'm buying more into a fund.
Yeah, that's true. I have, like, as a side note, not to get too distracted on this, but I get quite frustrated when I talk to people and they're like, oh, I'm not an investor. I don't know how to invest. And I was like, actually incorrect.
You are.
If you earn payroll in Australia, like, you are passively investing. The fact that you've never thought about it and the fact that you have like not engaged in that concept of being an investor, like, that's a separate thing. But like, the fact of the matter is you are making an investment. You made an investment decision when you decided your super fund.
And you are consistently.
And you are passively making an investment.
Yeah. Mm-hmm. That's pretty cool to think about though. Like, what if we could mobilize people to understand that a bit better and then be more engaged in the way that they invest just based on the fact that, hey, you're already investing.
Like, I think it would be amazing. Even just the small step of looking at your super construction. Like, most super funds will give you a nice little slider to say, I want to take more risk or less risk. And maybe even like check boxes of the kinds of products that they run that you can.
A nice little slider. Just slide that little bugger over.
Just slide me over.
Super risky. Lose all my money side. It also begs the question, like, if these super funds continue to grow and grow and grow, how does that affect the venture space, right? Let's bring this back to our space, right? Like, how does that affect our venture space?
Well, I want to come back to that, but the nuance that I want to add here, because I think to answer your question, why does this matter as a fund manager, is as a fund manager, you are holding an asset that is priced every 12 to 24 months, right? The revaluation moments are when there are new investors that come into venture. But, through one layer of abstraction, the biggest investors in this entity are getting priced every single month. And so what we saw over this period is a lot of pressure from the pension funds and the super funds to their fund managers to reprice their private assets because they were holding a bunch of assets that hadn't been repriced because there was no further valuations.
Rounds, yeah, because startups weren't raising rounds.
Correct. So they were like overpriced relative to what the super funds believed them to be and proved out to be, right? Like, if I think Canva got up to 62 billion.
There were some revaluations.
Yeah.
Yeah, and then it got revalued. Yeah.
So you saw Blackbird do that revaluation and they're going to, etc. Whereas in the US, there wasn't that same push because as an endowment fund, no one's buying units in your endowment every month.
Ah.
And so the biggest pressure that I see, or difference in pressure and how kind of big institutionals matter for your underlying investments, is that kind of how they are reporting the value of your assets. And the second is vice clauses. So vice clauses, as a fund manager, you sign a contract with the company, the fund of funds, the individuals and the institutions that invest in your fund. And you essentially say, I am committing to invest in this kind of company with these kinds of processes over this kind of time period. And then you make a bunch of commitments not to be a psycho or fraud or, etc. And also in that contract, you say, I will not invest in X, Y, Z. And these are vice clauses. They are very commonly, sex, drugs, alcohol, things of addiction, etc.
Ah, like vice tech.
Yeah.
Yeah.
So those vice clauses essentially say to the fund manager, you can't invest in anything that looks like this. So practically, we're seeing this be a real problem for anything in sex tech. A lot of Australian super, anything in the sex tech space, trends too close to those vice clauses, so fund managers won't touch them.
Yeah.
Anything in the kind of addictive substances space, so in the US, there's like the cannabis ecosystem is a real problem here.
Yeah.
Also, I believe you still can't transact an IPO with a cannabis company on the NASDAQ or any of the big stock exchanges in the US. So vice clauses are really relevant here. But other than that, it shouldn't change how a fund manager manages and invests in companies underneath. There is a reason that they're a big institution or individual is investing in a fund manager as opposed to investing directly, in that they are giving that ability to decide and manage to the fund managers and paying decent fees in order to be able to do it.
Yeah. I think a lot of funds have vice clauses, though, not just in Australia.
Oh, no, all over the world.
Yeah, all over the world, right? Like most funds will say, no, I don't invest in that.
Yeah.
Even if it's something like I saw one that was to help people quit smoking or drinking. I can't remember which one, but they're like, sorry, like it has to do with drinking, so no. Mm-hmm. And it's like, no, but it's to stop. No, okay, we'll just see ourselves out then.
Yeah. It matters all over the world. Let's remind ourselves that the big investors into these funds are universities, hospitals, pension funds. And so it matters what they make commitments that they will invest in things that don't do any harm and those kinds of things. And so they pass them on to their fund managers because they have to.
Yeah.
Rightfully so. I think it's an important thing. But I do think that they are slow to change and outdated, leaving a lot of value on the table.
Yeah.
Yeah.
Super interesting in terms of funds of funds. I'm really excited to see, like, obviously Australia is super nascent when it comes to this. The fact that we could barely name, any funds of funds.
I don't think there's one.
Yeah.
If you're a fund of fund listening and you exist in Australia, please reach out to me. I would love to know that you exist. I get an enormous amount of fund managers that reach out to me, especially emerging fund managers that reach out to me for like advice and like support as they're raising their funds. So if you exist and would like some deal flow, I have some folks for you. Or at the very least, it's just like start a website.
Yeah. Or at least we will know about you. We can mention it on another episode.
Yeah.
We can take a look. So I think if there isn't though, then that's probably maybe in the next frontier for Australia is what that looks like for us as we mature as an ecosystem.
I hope so. Yeah, I hope so.
Amazing. Well,
awesome.
Thank you for this insightful session, Maxine. I learned a lot, and hopefully this will help people with listening to the Trang episode. And when we say in parallel, not at the same time, like maybe before or after.
Yeah, I don't know that we needed to clarify that. Or maybe we did. Maybe someone was like, oh, I have to listen to this like with one AirPod in each ear as I listen to both in parallel. That would not be a pleasant experience.
0 out of 10 would recommend.
Yeah.
Awesome. Thanks for your time today, Maxine.
Thanks so much. This was fun. Sendar is the OG startup accounting firm in Australia, catering for all stages of your business's life.
If you're busy running your startup, you don't have time to do your own books and forecast. Instead, fully outsource your finance function, giving you time and resources back to focus on what you do best, which is growing your business.
For a free 1-hour consultation about your business's growth plans and finance needs, head to sendar.com. That's SCENDAR.com.